Andrew, I guess, part of it is stocks are up, it's a huge bull run, but then you have the political kind of machinations, and yet the market ignores it. So what will it take for a correction to take hold?
So I think it's about a couple of things, right? And it's important to step back. These are obviously very big, very historic headlines we have this morning, and yet, we've gone through an 18-month period where there have constantly seemed to be very big news stories emanating out of the U.S., out of U.S. politics, and the market has continued to charge ahead. So, look, I think what this market's going to focus on is a couple of factors. Does this politically, if we think about today's headlines, does this change the math for the midterm elections? Does this cause polls to shift in a material way? And I think that's the most direct way you could take kind of today's headlines to a market impact. But I also think the market's going to be watching very closely Friday in Jackson Hole. Does the Fed continue to sound like they are going to continue to tighten policy, tighten financial conditions? I think that's going to be very important, because the amazing thing really over the last 5 years is that the real long-run interest rate in the U.S., right, the real 10-year rate minus inflation, hasn't really moved very much. And so this market, while very impressive, has yet to really be tested by higher real rates.
Andrew, let me bring you over to one of my charts that the wonderful Hillary Clark made for me this morning. And this is the difference between the U.S. stocks relative to the rest of the world stocks. And you can see that actually there's a huge, huge premium when it comes to U.S. equities. And this, in part, is due to the tax cut. What do you worry about when looking about, this bull run in the U.S.? Is it that we're late cycle and the U.S. cuts could run out at the same time?
Yeah, so look, I think for better or worse, there's a lot of precedent of the U.S. market being a very strong performing market late in a cycle, of kind of being the last thing to break. And I think you can see that quite clearly from this chart. If you're based in the U.S., it's been a pretty good year. If you've been based outside the U.S., it's been a very different type of year. But I think that the thing that U.S. investors should be thinking about, or the biggest risk there, is the biggest risk that always faces markets, which is extrapolation, right? And so, we went from a period last year where the market was very skeptical of any tax cut passing, to some hope of it passing, to it passing, and now I think to those tax cuts being extrapolated in perpetuity to the future. And I think the risk is always that things change, and that always makes the market a little bit more vulnerable.